Oh man, I love toasted bread with guacamole. I mean, look at that. I bet that bread is so warm and crunchy. Ah, so good. Starting to get hungry, but first I have to talk about the spread. And no, not this kind of spread. We're going to be talking about the bid ask spread. So, first let's define what the bid and the ask is. The bid is the highest price that someone is willing to pay for a particular stock, while the ask is the lowest price someone is willing to sell a particular stock. Think of it as the same thing when buying or selling a house. You have an owner of that house whose bottom dollar may be to sell at $160,000, which is the asking price. While you may have a interested buyer whose top dollar is $150,000, which is the bid price. Now, this leaves a gap between the buyer and the seller of $10,000, which can lead to some wiggle room for negotiation. This gap is what we call the spread in stocks. When we refer to the spread in stock trading, what we are referring to is the difference between the highest bid and the lowest ask. Here we have a stock trading around $10. The highest price someone is willing to buy this stock for is $9.99. And the lowest price that someone is willing to sell this stock is for $10. The difference in price is 1 penny. So this is what we call a 1 cent spread. But sometimes the spread can get quite high, and this is why the spread is important to pay attention to. Let's say we have a stock trading around $10, but the highest price that someone is willing to buy this stock for is $9.85. And the lowest price that someone is willing to sell the stock for is $10.15. What is the current spread for this stock? The difference between the bid and the ask is 30 cents. So why does this matter? Well, if we wanted to purchase this stock right now at this point in time, what is the best price we can buy it for? It's going to be $10.15 because that is the lowest price someone is willing to sell this stock for. Remember, buyers buy from sellers. And since we are buying, we have to buy it from someone who is selling. And right now, the best price that someone is willing to sell this stock for is $10.15. So if we bought it at $10.15 and we wanted to immediately turn around and sell it, what is the best price we can sell it for? It's going to be $9.85 because that is the highest price at this particular time that someone is willing to buy the stock for. This means that if we bought at $10.15, we are automatically down on the position 30 cents because there is no one willing to pay more than $9.85 at this time. So if we bought 1,000 shares on a 30-cent spread stock, we would automatically be down $300. And maybe being down $300 isn't something you planned on or are comfortable with. So in order to manage risk appropriately, you may need to adjust your share size or only use limit orders to account for the range of the spread. Now, the spread can vary depending on a few situations. Most of the time when stocks have lower spreads, they're going to have high trading volume, meaning that there is lots of trading activity. People are buying and selling shares very actively. A stock can also experience low spreads if there is low volatility, meaning the stock isn't really trading fast, big moves. It just kind of steadily trades in price going up and down. If a stock experiences high spreads, usually what's going on behind the scenes is very low volume. Not many people are looking at the stock or actively trading it. So low volume can produce high spreads. Also high volatility. So big spikes in price, moving the stock quickly up or down, that can create higher spreads. So this is the criteria to kind of watch out for if you are concerned about the spreads. Now, if you plan on holding a stock for a few days, weeks, or years, then the spread doesn't really matter. But if you plan on day trading a stock, making quick entries and quick exits using marketable orders, then the spread is something definitely worth paying attention to. So I hope you all learned something from this video. Thank you so much for watching.